Hey, what is up everyone? It's David here. There is so much I want to talk about. And the first thing I want to talk about is Kuniko, which is a microcap company that spun out of Vulcan Energy Resources, skyrocketed 370% after it went public. And it went from 20 cents, which is the IPO price. When it opened, it popped to around 80 cents. And then at one point, it was at $3.60. If I could do the Jackie Chan meme face, that would be my face when I first heard of the Kuniko company. Now, the second thing I want to talk about is Affirm, a buy now pay later company led by PayPal Mafia Max Levchin, locked in a partnership with Amazon, giving customers a chance to use Affirm if they buy more than $50. Zip is lucky that this is only in the US. The question is, what will happen if Affirm and Amazon decides to launch the same partnership in Australia as well? Then there is the media clickbait of China banning US IPOs for data-heavy tech companies, and Peloton's earnings as well, which let's just say that it wasn't that pretty. Of course, towards the end of this video, I'll wrap up everything with a portfolio update, and all of the timestamps are in the description box below, so feel free to jump to a section, whichever that's most relevant to you. As usual, if you do learn something new, it will mean the world to me if you could gently smash a like button somewhere around here. And if you really like what I'm doing, consider supporting the channel via Patreon, where I share my thoughts a little bit more openly in Discord. For compliance sake, I happen to be a random Asian dude on the internet. So no, this video is not financial advice or recommendation to do anything. Without further ado, let's go. So the first story is Kuniko. And what you need to know is that Kuniko is a spin-off from European lithium explorer Vulcan Energy Resources, which for many of you have done incredibly well for this year. It basically went to the moon and some more. Now this move, the spin-off, if you will, was actually announced back in April, where Vulcan wanted to spin off all of its Scandinavian non-lithium battery projects into a brand new company so that they can focus on its core zero carbon lithium project in Germany. And within the company for Kuniko, it has some historical old assets that used to produce nickel, copper, and cobalt. Now, generally speaking, when a spin-off happens, it's essentially a company telling the market that we believe these assets are worth way more if we spin them out instead of holding them within a bigger company. So if that was the purpose, Kuniko did its job. It IPO'd at around 20 cents, and immediately when it went public, it went to 85 cents. And at one point, it did touch $3.60, but it was not captured. But the WTF moment is that the prospectus actually disclosed that online stock promoters got almost 2 million shares, equivalent to $375,000 at the IPO price of 20 cents. At $3.60, the stock promoter's position would have been worth $6.4 million. And at $6.4 million, it's almost 18 times return if the cost basis was around $375,000. Of course, on top of that, there are more opportunistic investors that's part of Telegram pump and dump groups that basically took advantage of this wave as well. So if you're into microcaps, please be careful with these purposeful pump and dumps. I go out of my way to avoid them because they're so speculative, but because institutional investors can't actually touch these, it does give retail investors an edge if you're willing to do the homework. Now, I have some general comments on the assets that are owned by Kuniko. And firstly, having an asset that can produce battery materials is very different to having an asset that can produce battery materials at the grade that the battery manufacturers want, and also can produce them at a high enough volume at the cost that the battery manufacturers can accept. At this stage, when I read their company presentation, it's just very hard to tell the quality of the material that they actually have or the cost of production. Secondly, one of the key value proposition of this company is that they own a cobalt asset in Europe, which means that they can produce cobalt in a more cleaner, ESG-friendly way. I would highly encourage you to dig into the historical documentation of that cobalt mine. And cobalt at the time, back in the days, was actually produced for coloring reasons. And whether the cobalt material is up to the battery manufacturer's grade, that is a complete separate story. But more importantly, from my understanding, and you can correct me in the comment section below if you think I'm wrong, automakers and battery manufacturers are trying to move on from using cobalt in their battery chemistry. So by the time this asset can actually produce cobalt, and let's just say it's high enough grade for batteries, the majority of the industry might have moved on from using cobalt in their battery chemistry. And finally, the biggest question I have on this company is that the assets they own are old. If it's valuable, how come the bigger mining companies like Glencore and Vale didn't jump in and buy them? There are way too many questions with too little answers, so this is a no-go for my own portfolio. Now, the next story is Affirm absolutely skyrocketing after they announced their Amazon partnership. In after hours, Affirm went up by 35%. That's absolutely huge. And I'm unsure how much they can actually hold on to that when the market reopens, but going up 35%, that's pretty crazy. So what we know so far about this partnership is that Affirm will let Amazon customers pay off splurges greater than $50 in monthly installments. And it also seems like they will not charge any late fees, and Amazon customers will know the total cost of using its services at checkout. But I think what is more important to Affirm is that if Affirm can capture 1% of Amazon's North American sales through this deal, it could add $900 million at top line revenue. And this is also really important to Affirm from the perspective that currently their biggest customer, Peloton, eats around 20% of their revenue. So having another big customer to diversify some of that big customer base, this is really good for a buy now pay later company like Affirm. I think it's too early to speculate what will happen if Amazon brought the Affirm partnership here in Australia. And plus, Australia is a smaller market compared to Europe and US. But in saying that, I do believe that buy now pay later is a winner take most industry. And having Amazon on its side in one of the biggest markets in the US, together with Square buying out Afterpay, I do think that the room for buy now pay later industry is starting to get smaller. So my existential question is, for those of you who are interested in Zip, and if the end game is being acquired by a bigger company, who do you think is most suitable to buy out Zip? Or do you think that Zip can actually stand on its own 2 feet as a company in the future? The next thing I want to talk about is this whole speculation around China completely banning US IPOs for data-heavy tech companies. Now, as many of you know, Chinese tech companies have not been, I guess, on the positive side over the last couple months. But if you really read into the report, it's essentially saying that China plans to propose new rules that will ban companies with large amounts of sensitive consumer data from going public in the US. It's all about proposing and also planning. I think what's really important to note is that China clamping down on its tech giants is no different to the Western world trying to create antitrust laws on its FANG companies. The only difference is that the Chinese tech companies doesn't rely on ad revenue, so they own the customer flow through and through. So imagine trying to buy traffic from these tech giants is just going to be really, really hard. It got so bad to the point that for some of the startups, if they don't take a funding check from these tech giants like Alibaba or Tencent, they might get completely locked out from their ecosystem. Whereas in the Western world, if you're a startup, you can still buy traffic from our tech giants because they rely on ad revenue. So I think the main takeaway, if you're really interested in Chinese companies in general, is that beyond the fundamental research you're going to do on these companies, please learn what is the 5-year plan for the CCP. There is some very detailed documentation and translation around that. And we just can't apply this Western lens of investing to the Eastern world because they play by very, very different rules. And we need to respect those rules and take those rules into consideration when we choose whether we're going to add them into our portfolio. Now, for me personally, I'm very happy with my Asia position. I don't plan to add more and I don't plan to sell. Okay, so the last thing I want to talk about before I share a portfolio update is Peloton's latest earnings result. Now, we know that connected fitness subscription jumped 114% year on year to 2.33 million during the quarter versus 2.28 consensus. Now, the difference between connected fitness and also paid digital subscription is that paid digital subscription is purely just accessing the content. Connected fitness is people who have equipment plus the subscription. So there's some slight difference just on that. And also adjusted EBITDA came in at negative 45 million versus negative 61 million consensus, which is good. Now, the reason why adjusted EBITDA is so negative is because of the treadmill incident, not to mention that the supply chain bottlenecks have added more costs as well. Now, looking ahead, the management team in the earnings call did mention that the churn rate for connected fitness is around 0.85%, which is incredibly low, by the way. And they did also mention that they are planning to lower the price of Peloton bikes across all markets to $14.95 or $39 a month. Now, as part of this announcement, there were a lot of speculation on lowering the prices of bikes being incredibly a defensive move. I don't agree with the public sentiment that Peloton lowering the prices of their bikes is considered as a defensive move when everyone else is jacking up their prices because of supply chain bottlenecks. Well, everyone else also don't have a subscription product to sell to their customers to increase how much that customer is worth over time. And also, towards the end of 2020, Peloton actually bought a leading gym equipment provider and manufacturer called Precor, so enabling them to produce their own equipment at scale that's going to give them efficiencies and cost savings with their products. The cost savings is actually mentioned by the CFO in the earnings call. And passing on those cost savings as a lowering of prices, I don't see how that's a defensive move, knowing that you can get more people onto your products and then sell them a subscription. Another point that was brought up on why Peloton suck is that recently in the balance sheet, there seems to be a buildup of inventory. They seem to completely ignore the fact that the peak season for Peloton is coming up. If you don't have inventory ready to be sold, the waiting time is going to be ginormous given the supply chain bottlenecks. So I'm definitely more neutral on the inventory buildup. I just don't think it's as bad as the public sentiment is describing to be. Overall, the earnings call, depending on how you look at it, it's not as pretty as it could have been. So it does create opportunities for those of us who don't want to add into Peloton at $160, but at a much more affordable valuation, which I think is a really good transition to talk about my portfolio update. With my CMC market portfolio side of things, is worth approximately 112,000 Australian dollars. I'll show you my US stake portfolio in just a second, but over the week, I actually didn't make all that many changes. I'm really happy with the positions that I have in my portfolio, and Asia is recovering, which is nice, but I'm honestly not too fussed about that. Micron is also recovering as well, which is good. Novonix and Talga, not going to touch for a long time. I'm happy with what I have. Volpara is just one of those things I'm going to leave for a little while, and I'll come back and revisit this. Volpara should really kind of sit in my short-term portfolio as well. And there are many comments and questions around Redbubble and NRW Holdings. Now, these are short-term positions for my portfolio, so probably not going to hold on to them for all that long, but for now, I have kept them. For CrowdStrike and Peloton, I've started build my Peloton position at 110 and then $106. So with the average earnings result, I do think that the share price will probably go below $100, which if that is the case, that's pretty attractive in terms of valuation. So I'll keep you posted on what I do decide to do with that. Over the week, I did deposit a little bit more cash, and if any opportunities come up in the next couple of portfolio updates, I'll keep you posted. With my stake portfolio, it's worth around 47,000 US dollars, which is give or take approximately 60 to around 61,000 Australian dollars. And I made no changes on this side. As I mentioned in my previous updates, I'm really happy with the positions that I have. And sometimes not taking action is actually the best action. So I don't want to fiddle or change my portfolio too often. I'm happy with what I have. I think in the previous updates, I did mention that I have sold off Ozone to replace that with Snowflake because it just presented a very quick opportunity because it sold off to around, I think, $250, which I saw it for a brief second and I just took opportunity in that. Now, I've done a lot of work in researching the company, and that's why I feel comfortable. If I didn't do it, then I wouldn't feel as comfortable in building a position like this. As usual, I am not sponsored by Stake, but if you do want to try Stake for yourself, I have left a link in the description box below. So thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.